Assalamualaikum warahmatullah and welcome back to the video presentation on insolvency and restructuring. This is the last video in this video series on this topic. In this last part of the video series, we will be discussing the capital reduction and receivership and liquidation. For internal reconstruction, that is also known as capital reduction, a company needs to have a special resolution supported by a solvency statement or special resolution and confirmation by the court or special resolution. For the special resolution supported by a solvency statement, a company will satisfy the test if A. It is not unable to pay debt right after the capital reduction, meaning the company must be able to pay its debt after the capital reduction. B. The company is able to pay its debt within the next 12 months, regardless of winding up or liquidations or not. And C. The company's assets must exceed its liabilities at the date of capital reduction. For special resolution and confirmation by court or special resolution, company has these options: to write off or reduce the liability on unpaid capital, to cancel the loss paid up capital or those capital not represented by assets, or to return the excess paid up capital. Under this resolution, creditors' claims are satisfied, settled or secured and consent obtained. Let us now look at an example of cancelling loss paid up capital or capital that are not represented by assets in the statements of financial position, that is option 2. Note that when we do internal reconstruction, it is always because our company suffers severe accumulated loss, and this accumulated loss eaten up the capital paid up. Therefore, a portions of capital will not be represented by assets as it has been eaten up by loss. Remember the accounting equation? Assets must always be equivalent to liability plus equity. In this example, we can see that the total assets is at 290,000 ringgit, while the capital contributed is at 300,000 ringgit, which is higher than the total assets. The company suffers accumulated loss of 180,000 ringgit, which makes the net capital to be reduced to only 120,000 ringgit. The 300,000 ringgit paid up capital has been eaten up by the 180,000 ringgit worth of accumulated loss. In other words, 180,000 worth of capital is not being represented by the assets of the company. To proceed, the company needs to come up with a plan to cancel the capital that are not represented by the assets. It needs to reassess all of its assets and liabilities. For this case, the company were given two values of total assets after reassessment: the going concern value of 260,000 ringgit and the liquidation value of 185,000 ringgit. Now, since the company is not liquidating, thus it will go for the going concern values. And from here, we can see that the values for motor vehicles and plant have been reduced to 40,000 ringgit and to 30,000 ringgit respectively from their initial balance. It means that the values of motor vehicles and plant have been reduced by 10,000 ringgit and 20,000 ringgit respectively. Note that we need to record these changes in values when we actually implement the plan, if it is agreed to. The first step after the reassessment is to determine the loss of capital. We basically compare the revalued amounts of all assets with the liabilities and equity. As we can see from the illustration, the loss of capital is determined to be at 210,000 ringgit. In step 2, the management or judicial manager must come up with a plan to cancel the loss determined earlier. And as mentioned in part 1 of this series, the plan must be agreed by shareholders and creditors. In this illustration, the plan is to reduce the value of ordinary shares to 30 cents each and considered it as fully paid up at that value. The company's shareholders also has agreed to take up 2 fully paid ordinary shares for every one that they own. This simply means that they agreed to contribute more capital by subscribing to 2 new shares for every one that they own. This is necessary for the company to continue its business as it needs cash. From the cash received, the bank overdraft will be paid, and this plan is approved for capital reduction. For this illustration, we need to show the journal entries for the above plan. We also need to show the capital reduction account, an account temporarily open specifically to carry out the internal reconstruction. And we need to show the statement of financial position after the capital reduction or the implementation of the plan. So here are the journal entries that we should have to reflect the implementations of the agreed plan earlier. To reduce capital, we debit share capital or capital contribution account with the total capital loss determined earlier at 210,000 ringgit and credit capital reduction account with the same amount. To eliminate the accumulated loss, we debit capital reduction account with the amount of accumulated loss of 180,000 ringgit and credit accumulated loss account with the same amount. So now we have eliminated the accumulated loss account. Finally, to write down assets to their current values determined earlier, we debit capital reduction accounts of 30,000 ringgit and credit motor vehicles and plant accounts with 10,000 ringgit and 20,000 ringgit respectively. To record the cash received, we debit bank accounts with 180,000 ringgit and credit share capital account with the same amount. And to record the settlement of bank overdraft, we debit bank overdraft account with the amount of overdraft of 90,000 ringgit and credit bank account for the payment made. The capital reduction account should look like this. Remember that this account is a temporary account that is opened specifically for this purpose. It should not have any balances. And finally, the statement of financial position should look like this after the implementations of the agreed plan for the company to carry on its business. Basically, the challenge of this process lies in the determining of the plan that would be agreed by all relevant parties. For the recording, we simply follow through what agreed to be implemented. In Putra Blast, I have shared some exercises from Lazar 2018. Please have a go at them by applying the basic principle. Just follow the agreed plan. If there is excess paid-up capital that need to be returned to shareholders, the journal entry is simply debit share capital to reduce the amount and credit bank to record the payment. Let us now move on to receivership and winding up or liquidation. This option is chosen if the company has no potential or prospect to rebuild itself. Let us first look at receivership. Remember in part 1 of the series, we talk about receiver and receivership. Receivership is a process in which a legally appointed receiver acts as a custodian of a company's assets or business operations. And this happened when the company is filed for liquidation or bankruptcy, and also for restructuring. The common events that lead to the appointments of receiver in a company include failure of the borrowing company to service or pay its loan in accordance with the terms of its debenture as the secured creditors, and a presentation of a winding up petition against the borrowing company by creditors. The main functions of receiver and manager in this arrangement is to take over the control of all the company's receivables. Section 524 of the Companies Act lists the rights and duties of the secured creditors if you are interested. Once a receiver and manager is appointed, basically they will take over the management of the company from directors. This simply means that directors now has no power to do anything as their powers are suspended. The receiver and manager will realize the assets of the company to repay the debenture holders and at the same time must prudently manage the company. In reality, though, this could be the beginning of the end for the borrowing company. Directors of the borrowing company, however, could challenge the appointments of the receiver and manager via court. The appointments of receiver can be done privately or by court. For a private appointment, creditors may appoint their own receiver and manager to manage the settlements of their debts in the borrowing companies. At times, directors of the borrowing companies might want to change the receiver and manager if they are found, to them, to be too aggressive and might, in their opinion, destroy the company in its way to settle the claims by creditors. Alternatively, the court can appoint receiver and manager where they are allowed to sell the assets of the borrowing company where they see fit to settle the claims by the creditors. One thing that creditors consider when deciding to appoint a private receiver is cost. The cost is anticipated to be a lot less since private receiver is not tied to the decision by the court, while a court-appointed receiver need to go to court to get approval for action taken during the process. Another thing to consider is the liability of the receiver. In Section 381 of the Companies Act, it states that any person appointed as a receiver is liable for debts incurred by him or other authorized person in the course of the receivership or possession, for services rendered, goods purchased or property hired, leased, used or occupied unless otherwise provided in the instrument appointing the receiver or receiver and manager or other authorized person. In Section 382 of the Act, it states that the liability of receiver, where a receiver or receiver and manager is personally liable for a contract entered into by him in the exercise of any of his powers, unless specifically provided otherwise in the instruments appointing the receiver or receiver and manager. However, for receiver or receiver and manager appointed by court, the court provides protection for them. Winding up or liquidation usually happens when there is no hope for the company to survive. However, as we discussed earlier in Part 1, it can also happen to solvent company that chooses to liquidate. This is to allow the assets of the company to be distributed back to shareholders after paying off debts. As was insolvent company, by filing for winding up or liquidation, it allows an orderly and fair distributions of the assets among creditors. It also allows the company to serve the greater good by dissolving the company instead of continuing the operation and thus continuing to hurt shareholders and creditors. And it also allows an independent and appropriately qualified person to investigate the affairs of the company. The process of winding up involves liquidating the assets of the company, paying its obligation or liabilities, distributing remaining assets or monies to shareholders, and finally dissolving the company as a legal entity. Therefore, once a company files for liquidation and accepted by the court, a liquidator will be appointed to liquidate the assets, pay off debts, and distribute the balance to shareholders. Board of Directors and the management of the company at this point has no power. And eventually, after all the necessary steps are taken, the company will be dissolved. So that is the end of the discussion on insolvency and restructuring. For further details, you may want to check the Companies Act for the relevant provisions. Again, the main challenge for insolvency and restructuring is to come up with a restructuring plan that would be agreed by shareholders and creditors. And for winding up, The challenge is to come up with a plan to settle the claims by creditors. The recording part is quite easy as we simply need to follow the plan as it is implemented. That is the end of the series. Please replay the video if you think that you missed anything. But for the most part, we do not discuss details of the process. So if you are interested, you can always find the relevant sources online and offline. So that is all from me. Thanks very much everyone for your attention, and wassalamualaikum warahmatullahi wabarakatuh.